Hi, thank you everyone for coming in. So as you all know that the discussion for this webinar is going to be focused on federal finances, but of course we are open to taking more questions which are not necessarily covered in this presentation. We'll do a half an hour presentation between me and my colleague Herschel, and you can stop us in between the presentation, or we can take Q&A once we are done. And of course, as I said, we can, discuss things which are not necessarily fully covered in the presentation. Owing to time constraint, we'll obviously try to sort of keep it really short in terms of, our key pointers. So, the reason why we are sort of trying to understand the federal fiscal policy, especially post-pandemic, is to understand how center and states have sort of behaved, very similar and yet very different in terms of their fiscal prudence. Just to give a quick recap, post 2013-14, center has been sort of on a consolidation path. They've been trying to reach the FRBM target of 3%. But of course, owing to COVID, the consolidation path was sort of disturbed. States, on the other hand, have been slipping their fiscal targets post 13-14, partly on account of the power reforms that they had to take up, which led them to take the debt burden on their books in a more transparent fashion. But post-COVID, what we saw was that both center and state started aligning towards consolidation. Obviously, COVID disturbed the federal fiscal policy in a large fashion, where we saw the debt to GDP ratio now soaring close to 89% of GDP. And since then, center and states both have been pretty much focused in terms of consolidation. States in aggregate have managed to be fiscally prudent despite the fact that they were facing revenue issues. But interestingly, what we saw was that the way the center and states were aligning the consolidation very, very different. Center was able to do so every year. They have been able to sort of, outpace their numbers or have been comfortably able to match their fiscal post-COVID, largely on account of the fact that they have been seeing a very strong revenue stream, which helped them ensure that whatever is the expenditure stream that they have planned for the year, they were largely able to achieve that. States, on the other hand, have not only overachieved on their fiscal target last 3 or 4 years, whenever they have sort of come out with a fiscal deficit target, which is generally sub 3%, they have actually, undershot that also and have been generally, doing better than what they budgeted. The difference here is that both center and states, while consolidated, center, as I said, was able to do it owing to better income. States, on the other hand, were struggling to really have a strong income profile. But they still essentially tried to consolidate by cutting their expenditure to a large extent, which was led largely by capital expenditure. Just to make it a point, the states generally have been treating capex as a residual item in their expenditure kitty, wherein large part of the capex happens in the fourth quarter of the year. And they tend to always undershoot their capex target by at least 20% on an average of the initial budgeted. And large part is essentially done towards the end of the year when they're aware of their overall spending pattern and their revenue pattern. So in this note, we are basically trying to understand what essentially has changed post-COVID, what essentially has changed post, the recent, changes in the political economy, where the political map has become less BJP oriented. Has the budgetary choices evolved very differently? Are we seeing, states behaving in a more uniform fashion in terms of probably disturbing their fiscal profile? If that is the case, what is the economic cost of it for federal government as well as obviously for states? Just to give again a quick pointer, for this year, states have budgeted around 3.3% of fiscal deficit. This after having seen at least 7 states coming out with their modified budget. Despite that, the FD to GDP ratio for states has remained 3%. Last year, they had budgeted 3.2% for the 19 states that we tracked. But they ended up again undershooting by just printing 2.8% fiscal deficit, which was still higher than FY23, but again, much lower than what they budgeted beginning of the year. This year, while they are budgeting a 3% fiscal deficit from 2.8, which is a widening of fiscal deficit, as against center, which is trying to consolidate the fiscal deficit. As of now, the borrowing profile of states have not been too disturbing except for the recent weeks or so. But, the kind of revenue forecast that they have built up in their fiscal profile for this particular year has made us believe that, we are in for a very messy state finances going ahead. There are multiple fiscal risks which are there and which vary across states also. And especially on account of the fact that they are going to struggle on their revenue stream, on their income stream, amid the non-merit subsidies that they have come out with, especially around the election time, which is led by, of course, freebies as well as subsidies like cheaper electricity. And these state-specific fiscal gullibilities are going to probably sustain for the next few years or so, and we are probably going to be seeing a very divergent center and state fiscal profile, wherein states may continue to struggle unless they find ways and means to mobilize their revenue, and which is where we're going to focus our bit on. While center at this point in time is going to be, at least for the next 2 or 3 years, is looking to be quite comfortable on their revenue stream. And thus, while the overall fiscal deficit for this year is looking to come off from 8.4% to probably 8%, there's a good chance the center may actually print a lower fiscal deficit than 4.9%, which is what they have budgeted. And states, on the other hand, while having budgeted 3% fiscal deficit for the 19 states that we track, could actually come out to be as high as 3.2%. And there's a good chance that, amid weak revenue stream, their spending pattern may become much more stickier than what it was in the last 5 years or so. With that, these are the 5-6 things that we are going to be covering, and I'll hand it over to Harshal to pick it up from here. Harshal, are you there?
Yeah. So as Madhavi said, these are the sort of 5-6 key things and factors and segments we're looking at. She's already spoken a little bit about how the center and states consolidation has sort of deferred post-COVID. So I'll just quickly touch on that and then move on to the other segments. So essentially, as she said, both the center and states on a headline basis, obviously the fiscal deficit has come down post-COVID. Last year was an exception where the state's fiscal deficit rose from FY23. FY23 was 2.6, it increased to 2.8. So this was the first year where the trend was broken from the state's point of view, even as the center consolidated further. But if you look at, obviously, before FY24, state's deficit had also been coming down, but the way in which they were doing this was very different to what the center did. So as these charts also show, the center's revenue growth has been quite solid post-COVID, averaging about 18% YOY, whereas the state's revenue growth has been much lower. So essentially, the higher revenue growth that the center has managed to accrue allowed it to focus on capex. So therefore, the capex growth is also much higher than the center, than states, while controlling revenue expenditure. While for the states, it's been the exact opposite. Because their revenue expenditure pressures are higher, their RevEx growth has been higher, and therefore they've had to sort of compromise on capex. Now, last year was a bit of an anomaly in that sense, because for the first time in a long time, the states followed the center's behavior on capex. They front-loaded capex, and last year states achieved, on aggregate, the 19 states that we track, achieved about 90% of their FY24 budgeted numbers for capex, and this is the highest achievement rate since about FY17 or so, because as Madhavi said earlier, they sort of average about 85% of budget achievement on capex on average over the last decade or so. So last year was an anomaly in that sense, but as I'll show later, even that was sort of driven by only a few states, and in general, states have sort of been focusing more on controlling their deficit by bringing capex down, because their revenue expenditure pressures have been much higher. Now, for this year as well, we are estimating that sort of states will step up in terms of their budgeted numbers for the first time since about FY21, which is the COVID year, that they will actually print a higher deficit than what they've budgeted. So we are budgeting about 3.1 to 3.2%. We are estimating about 3.1 to 3.2% of fiscal deficit this year for states versus the 3% that they've budgeted. So 0.1 to 0.2% of slippage. And the reasons for this are twofold. First, revenue growth is going to be much lower than what they've budgeted. So states' revenue growth assumptions are quite optimistic. They've budgeted about 18% growth in revenue receipts, 18% growth in SGST, and this is FY25 budgeted numbers versus the provisional, not the RE. So when states do their budgeting exercise in Feb and March, they obviously look at the revised estimate numbers, and based on that, they make their next year estimates. But the provisional numbers that we have from the monthly accounts that we get, so for the provisional numbers for FY24 were much lower than RE, and therefore for FY25 at present, if compared to the provisional numbers, those numbers look quite optimistic. So SGST, for example, budgeted at 18% is quite unrealistic if the center is budgeting about 10-11% growth in GST. in its own GST collection. So firstly, the fact that their revenue estimates are going, their actual revenue accrued is going to be much lower than the revenue estimates they've made. And second, that the expenditure pressure is higher, led by revenue expenditure through the sort of bevy of populist announcements we've seen across multiple states this year and even last year due to the elections. So essentially, revenue is going to undershoot massively, whereas the room for expenditure to undershoot is lower, and therefore the axe will again likely fall on capex, which is already quite significantly lagged and is unlikely to pick up significantly again. I mean, even if it does, it's unlikely, it'll probably undershoot significantly in the second half. So these are essentially the reasons why we feel there's going to be a slippage for states this year. So these are just the aggregate sort of numbers for the 19 states that we track across the last few years and the growth rates as well. So as I was saying, you can see that states on an aggregate have budgeted about 18% growth in OTR, own tax revenue. SGST is budgeted at 18%. All the tax heads are essentially budgeted at quite high rates, which look unrealistic to achieve. And even another sort of key line item, which is grants in aid, which is the grants that the states receive from the center. There's not devolution. There's not the tax sort of contribution from the center that they receive. That is devolution. Uh, grants in aid is also budgeted at 41% YOY after declining 24% last year, and this is not. There's no way this line item will grow by such a high amount, given that the center is actually budgeting lower grants in aid going forward as well. The Finance Commission grants are budgeted to come off based on how the Finance Commission has sort of laid out the path up until FY26. So that is another key line item where states' revenue, overall revenue, is likely to fall short. So that's as I said, underpinning our assumption or our estimate that states will slip up this year. So on a cross-state basis, also, if I look at how states have budgeted their numbers this year, about 11 of the 19 states are budgeting higher numbers or higher fiscal deficit this year versus last year. Now, that in itself is not a concern because, as the chart shows, they've sort of undershot their budgeted numbers for the last few years. So it's not a case that, if they budget a higher number, that the actual will be higher. But the concern is that, as the next section touches upon, the fact that multiple states have gone for freebie-led spending this year, and that is likely to put sort of upward pressure on these numbers for FY25 from an expenditure point of view. Now, as Madhavi said earlier as well, if you look at the 5-month data that we have, so we have fiscal numbers till August from the monthly sort of numbers for each state. The 5-month data so far is not too concerning because, the expenditure side hasn't grown too much. But if you look at the revenue side, it's quite tepid. Total revenue growth is only about 5%. Tax revenue is only 11% or so. SGST is only about 10%. So more or less in line with what the center has budgeted, and not the sort of higher growth estimates that the states had taken, which you can see about 15% for tax revenue, 18% for OTR, as I showed earlier. So on the revenue side, the sort of growth has been quite tepid, and on the expenditure side, on aggregate, it's not too concerning. One of the key items to look at is the subsidy sort of line item, which is growing at about 34% YOY so far, versus 26% budgeted. So it's already growing at a faster rate than 26%, which is obviously still quite a high number. So up until now, subsidies have grown quite significantly, and there's obviously a result of the sort of higher populist spending that has been announced so far. All of that will not come under subsidies. That will come under overall revenue expenditure, which is still sort of contained. But as we're saying, the upward pressure here is going to be significant in the second half. And capital expenditure is also lower than last year at about 7% negative. There's a bit of a base effect here as well, because as I said earlier, states had front loaded in the first half of last year. So the base is higher and they've not spent this year because of the elections. So that is essentially the reason why the number is negative, but the catch up is quite significant. So states will essentially have to achieve a 30% YOY growth over the next 7 months of this fiscal year to be able to meet their budgeted target. And that looks like quite a steep ask, especially because it is more difficult for states to sort of ramp up than it is for the center. So this is essentially what we were talking about, where there's been a high or there's been the breadth of populist spending has been quite staggering this year, this time around, because it's happening across states and across party lines. It doesn't matter which party is coming to power or which party is in power, and which state it is, whether it's fiscally sound or it's already on a bad sort of fiscal footing. All states have sort of followed this path from last year onwards. So as you can see, these are the sort of 10 of the 19 odd states that we track, the states that have had elections or will obviously go to elections in the case of Maharashtra and Jharkhand in the next month or so. The sort of major schemes they've announced and the estimated cost of all the schemes. So this is not the incremental cost, this is the total cost allocated to populist measures, and as a percentage of their own, how much this amounts to as a percentage of their own GDP. So you can see some states like Maharashtra, and there is a slide on Maharashtra specifically as well, uh, have allocated quite significant amounts to populist schemes this time around. And there are 6 states so far which have announced new budgets in FY25 after having announced a budget initially in Feb or March. And Andhra Pradesh was also likely to come up with a new budget sometime in November or December. So of these 6 states, 5 have increased their fiscal deficit to GDP versus their initial number for FY25. And Telangana, in the case of Telangana, which has actually reduced it, I mean, it's actually done so by increasing its non-tax revenue and non-debt capital receipt estimates by huge and extremely unrealistic amounts. And this has happened in a year where earlier in the year, the CAG had publicly pulled up Telangana for having unrealistic budget estimates, especially for these two heads of revenue. And it's done the same thing this time around. So it won't be a surprise if Telangana actually slips up as well. But other states, as you can see, have all increased their fiscal deficit by about 0.3% on average of GDP, and their revenue expenditure for all states has gone up by about 0.8% on average. So you can see that there's obviously been a significant shift towards populist spending, and that is essentially why we're saying that there's a big chance of a slip up this year, because it is happening across states. And this is a more medium term concern as well, because as more and more states, as you go along and as more and more states come up for elections, it will be very difficult for them to sort of resist this populist tug as well. I mean, Bihar goes to polls next year, for example. If you've had Orissa, Jharkhand, Chhattisgarh all announcing financial assistance schemes to women in the last year or so, it will be very difficult for Bihar to not follow suit. So that's also the point we're making, that this is now a medium term concern, and it's become a race to the bottom where each state will have to follow suit to just keep up, and they can't not fall, not succumb to the pressure. So on the subsidy bit, before I move on to Maharashtra, what we're saying here is that the as we had showed earlier, subsidy expenditure is budgeted to grow 26%. It's obviously growing at a much faster rate in the first 5 months, but that is a significant uptick from last year. And subsidy expenditure is budgeted about 9%, just under 9% of both states' revenue receipts and their revenue expenditure. So it's becoming a big chunk of states' expenditure and also their revenue. What we're saying here is that even though there's been quite a lot of reform in the power sector over the last decade or so, with the Uday scheme that was launched and post the Uday scheme essentially, there is now a concern because after the financial assistance scheme to women, one of the most populist measures that has been announced is power subsidies, whether to farmers or overall to the entire population or whatever chunk of population. So with power subsidies again becoming prominent across states, the likelihood of this now stretching state finances again increases, because as you can see, for a bunch of states, power subsidies account for the majority of subsidies. So Rajasthan, almost the entirety of its subsidy budget is for power. There's hardly any other subsidies it gives out. Bihar is at about 80%. Punjab, Telangana, UP, they're all above 70%, even Haryana. The average is about 50 odd percent for the 19 states we track. So already power subsidies make up a significant chunk of state subsidy expenditure, and this is only going to increase if more and more subsidies are being announced. And this has a direct impact on the health of the discoms, of the various state discoms, which was improving again post Uday. So now what we've seen is that uh, discoms actually are getting higher subsidies than what they're billing states for, which was the case in FY22, as you can see here, because states are obviously paying back some of the former dues as well. And now there are a lot of mechanisms in place to ensure that states pay up. So, if they don't make the payments on time, the discom can simply just shut off the electricity supply to the state. So there is no option but for states to pay these bills. So the way in which this now impacts the state is obviously the higher subsidy expenditure will come on the books of the state's fiscal itself, rather than being transferred to discoms by delaying payments. But even if they manage to somehow delay payments, it is still a contingent liability. So the outstanding debt of state discoms is still a contingent liability for states. So at the end of the day, they will still have to bear the burden if a discom fails. So for a bunch of states, again, the debt to GDP ratio for the discoms is quite high. So for if the discom sort of health goes worse because states are delaying payments, if at all they manage to do so, that will also come back onto the state's fiscal and I mean impact the state's health, fiscal health, and come back as an expenditure that they'll have to bear. So in either way, either directly through higher subsidy expenditure or through the discom, the higher subsidy payments for power could impact state's fiscal health in one way or the other. And lastly, before the next section, what I was talking about in terms of Maharashtra specifically. So obviously Maharashtra goes to polls next month, and the budget it had announced uh, at the start of the year was showing they had budgeted about 2.3% of fiscal deficit to GDP. This was increased to 2.6 in July when they released a new budget, which was also when they announced the the Ladki Bahin scheme, the 1,500 rupee per month assistance to women. Now, the entire increase in this sort of the revenue deficit has also gone up by 0.3%, and the entirety of this increase is due to higher revenue expenditure. So they've rejigged revenue expenditure. They've cut expenditure in some areas to allow for higher expenditure in other areas. But the entirety of the increase is coming from revenue expenditure because the revenue side has not increased by much. It's only increased by about 7 billion, which is due to higher grants in aid from the center because they had more clarity post the union budget, and capex has been increased by more or less the same amount. So the entire increase is coming from the revenue expenditure side. And as I was showing earlier, the total sort of populist scheme allocation is about just under a trillion, which is about 2.2% of GDP and about 19% of revenue receipts for FY25. And the major scheme obviously is Ladki Bahin, which is budgeted at about 460 billion, which is 1.1% of GDP. And to put this into perspective, it's more than the entire sort of allocation that they've done for agriculture spending. Now, there are obviously other schemes that have been announced, even in the last couple of weeks or about a month or so. A bunch of other schemes have also, or other sort of spending has also been announced. So this amount may actually be higher in terms of the actual. But the point we're making is that, so two sort of key takeaways are that one, committed expenditure excluding this subsidy spending was already at about 55% budgeted. If you add the 19% going towards populist measures, only about 26% of revenue will be left over from the budgeted numbers for Maharashtra for any discretionary spending, which includes capex. So we are expecting Maharashtra to significantly undershoot its capex targets this year, the state government's capex targets. It's for the first 5 months of the year as well, it's barely done even 20% of what it had budgeted, of the full year budgeted target. So it's already lagging quite significantly. And if with the election coming up and the results towards the end of November, it's unlikely that any pickup will happen before Jan. And then in the last 3 months, it's again unlikely that they'll ramp up to an extent where they meet the budgeted number. And secondly, given the fiscal pressure that Maharashtra is facing, we expect Maharashtra to borrow a lot more from the market in terms of SDLs, and they are already doing so. Q3 has seen a pickup in borrowing from Maharashtra. They've been coming to almost every week to the auction. And we expect this to pick up, especially in Q4 as well. So Maharashtra is likely to be a significant borrower to fund these programs this year. And then, of course, it has medium-term implications as well if this sort of spending pressure continues, because even if the government changes, it is very difficult for a new government to roll back any of these schemes. And I believe Aditya Thackeray has said that they will not roll back the Ladki Bahin scheme if they come to power. So this becomes a sticky sort of expenditure that and the cost could also possibly go up every year. Or even if it stays flat, it still is a significant sort of expenditure burden that is going to sort of the fiscal will have to bear in the years to come as well. The next section is essentially what we are talking about in terms of revenue mobilization, where, as I said earlier, the revenue estimates look quite optimistic versus what the center is budgeted. So that is where we feel there's likely to be a significant undershoot across states. And as you can see, in terms of tax buoyancy as well, the budgeted numbers look quite unrealistic because the states have budgeted about 1.7 in terms of their own tax buoyancy, whereas the center is at about 1. So it's unlikely that there can be such a high divergence between the center and states. And with a slowdown in, say, SGST makes up over 40% of states' own tax revenue. So if SGST budgeted at 18% comes in at about 10-11% actual, obviously a significant chunk of revenue will see a slowdown. And what we are also arguing is that this will have sort of the impact may be diverse across states because some states have other sources of revenue that they've tapped. So UP is a good example there, where if you look at UP, so these are essentially in percentage terms, each shares breakdown of its OTR. So uh, uh, how much each head contributes to its own tax revenue in percentage terms. So for Uttar Pradesh, about 23% of its own tax revenue comes from excise duty, which is the highest ratio across these 19 states. And even on a CAGR basis, if I look at the numbers, UP's excise revenue has grown by about 19 or 20% CAGR over the last 5 years. It has essentially revamped its entire distribution model. It's moved away from a sort of bidding process to an e-lottery to make it more democratized and make it less prone to corruption. And it's allowed both organized players to get into the space and also smaller players who may not have been able to do so earlier. And it's widened the base essentially. It's not really fiddled with the rate as such of excise duty, but it's widened the base, and that can be seen in the fact that um, it's budgeting over 500 billion of revenue just from excise this year. It touched about 440, 430 odd billion last year. So that is one sort of reform that a lot of other states are looking to copy in terms of garnering more revenue, especially from liquor sales. But what a lot of states have done in general is they've tried and sort of tweaked the other two levers that are in their hands. Obviously, they can't do anything about SGST rates as such, other than through the GST Council, which will obviously take time in terms of rationalization. But a lot of states have either increased excise duties or stamp duties. So to try and get more revenue, a bunch of states, as you can see over here, have done so in the last couple of years because revenue from other heads is sort of slowing down. And that's what we're saying, that because they are facing pressure both from the transfers to center end as well as own tax revenue growth otherwise, they're trying and pulling at any levers they can. But the UP model, in terms of the excise reforms they've done, may be something to watch out for across states. Some of the southern states are also looking to replicate it. Maharashtra also maybe. So that may be something that may happen across states in terms of reform as such. Uh, this slide is more of a sort of medium term look at how SGST collections have worked over the last 5 years since its introduction, more than 5 years, since 2017, since its introduction. And the actual data is sort of at odds with what the initial concerns were. So states had two concerns when GST was implemented. First was that more populous but less industrialized states, so the likes of Uttar Pradesh, Bihar, West Bengal, would accrue higher growth because of the higher population would sort of consume more goods, and therefore the likes of Gujarat, Tamil Nadu, Maharashtra, which are relatively less populous but more industrialized, would sort of lose out on a relative basis. But it's the exact opposite, that the actual is in terms of how the growth has panned out. So all India CAGR for GST collection in the last 5 years has been about 12%, just under 12%. But these states that I said, so UP, Bihar, West Bengal, have all got their growth rates have been much lower than what the all India rate has been, and the likes of Maharashtra, Tamil Nadu have all had higher rates, or just about the rate that the all India collection has grown at, but higher than these states. So that first concern, essentially, that more populous states will consume more and therefore get more GST growth, has not panned out. And the second sort of linked concern was that consumer states, again. So if you look at e-way bill data, you get outbound and inward e-way bills, right? So subtracting the two will give you a sort of rough estimate of which states, quote unquote, export goods and which states import goods from other states. So the concern was that higher consumer states would benefit more. So again, the likes of UP and Bihar, and more net exporting states would lose out. But that's not been the case. Again, if you look at this chart, it's been the exact opposite. So the likes of Gujarat, Maharashtra, Orissa have all had much higher 5-year sort of growth rates for GST, and their per capita sort of GST collections have also been much higher than the likes of UP and Bihar. So the point here is that more populous states will not be able to rely just on higher population to be able to get GST growth sort of benefits. You will have to sort of conduct more reforms and increase the income and consumption capacity of your population. So to get the benefits of GST, the way the GST sort of thing structure is in place, and therefore this is a concern for these states, for these larger population states. and again from a more medium term point of view, because this is already played out over the last few years and it's only going to be more sort of in focus in the years to come. And in terms of the revenue bit, the last bit here is what I was talking about in terms of transfers, that transfers from the center to states is only going to be falling. So as a percentage of the center's revenue receipts, all the sort of transfers that the center does, including devolution, are budgeted to come down to about 54% of the center's revenue versus a high of 59% in FY21, which was the COVID year. So these are all budgeted to come down on aggregate and come back to closer to where they were post pre-COVID. So obviously this is an ongoing sort of issue that states will have to manage. And even on the devolution bit, even though absolute devolution has been growing because the center, as we said earlier, is getting healthy tax growth, uh, the center has not been sort of the devolution is not touching the 41% that the center has been, or rather the finance commission has recommended, uh, the 41% of the divisible pool. And this is essentially because cess and surcharge is forming a bigger and bigger chunk of the center's tax revenue, and this at present does not have to be shared with states, although this is something that the new finance commission has taken up. States are asking that that is also could also be shared, but even if that comes into fruition, that is still at least 2 to 3 years away, because FY27-26 is when the new finance commission recommendations will come into effect. So this is again on the revenue side from the center's point of view, what we were talking about, the sort of threat that states are facing to their revenue on a more medium term basis as well.
Any
On the
questions, anyone?
Yeah,
Before we
I'll
move
just
to the
pause here.
capital.
Yeah.
Yeah. Just to give a quick summary, basically, we've tried to understand, why states have put very high revenue estimates and why those revenue estimates are bound to bound to fail, sorry. And, it could have implications on their spending pattern, of which we are now going to be covering the capital expenditure, which will be probably, the one which will bear the large part of the burden with regard to higher revenue expenditure spending and much lower revenue or income bit of the states. Any questions? Otherwise, we'll just move on. Actually, chalo aage बढ़ते. Let's go ahead.
Yeah. So on the capex bit, as I said earlier, last year was an anomaly where states managed to achieve 90% of their budgeted capex. This meant that obviously based on the provisional numbers that we have, states achieved about 2.3% of capex to GDP, which is the highest ratio since the COVID year. And even if I exclude that FY21 year, it's one of the highest ratios since about in the last decade or so. This year, states have budgeted about 2.5% of capex to GDP, but we are arguing so about 18 to 19% growth has been budgeted. But as we've said earlier, it's unlikely that this will be done. And even if you look at the 90% of budget number that they achieved last year, this was led by a few states. So the likes of Madhya Pradesh, Telangana, Bihar, Himachal, these were the sort of states that achieved even more than what they had budgeted, with most states actually undershooting their budget estimates, and some large states are there. So the likes of UP, Chhattisgarh, Andhra did only about 70 to 75% of their budgeted numbers. So even the sort of front loading and the heavy number that we had for last year was led by very few states. And this year, therefore, if I look at the progress of budget estimate that has been done so far, because of the front loading last year and the lack of spending, states have only done about just over 20% of the budgeted number so far, which was close to 27-28% last year at the same time last year. And if I look at cross state numbers, no state has done above like 33-35 odd percent of its budgeted number. And some major states, the likes of Andhra, as you can see, Andhra, Maharashtra, Chhattisgarh, Uttar Pradesh, Orissa, they've not even achieved 20% of the budgeted numbers yet. And that is essentially why we're saying that the pickup that states need to do in the last 6-7 months is quite high, and there is likely to be a cross state shortfall in capex, and therefore there might even be a negative as in a YY decline in states capex this year from what they did last year on an aggregate basis. This is essentially this slide is talking about the committed expenditure burden that states are facing. So earlier I spoke about how this number for Maharashtra is as high as 75-76% this year because of the higher subsidy spending. But on aggregate, it is at about 54-55% for all states. States are budgeting about 7.6% of GDP in terms of their committed expenditure spending. So salaries, pension, interest, and subsidies all taken together. Uh, in general, states obviously undershoot this number, but it is unlikely that the subsidy number will be undershot. So there is upside coming from there and also from the salary bit because, for example, Karnataka has implemented the 7th Pay Commission sort of recommendations this year. So it's giving employees a 59% hike in salaries. So that alone is likely to cause a significant upshot on an aggregate basis, and even from some other states that might be the case. So we're saying that even if this number is going to be undershooting the budget number, it will do so by a smaller amount than in previous years, and definitely subsidies will be higher than what they budgeted. So essentially, the space they have to do discretionary spending will be lower because a larger chunk will be taken up of revenue will be taken up by these heads. And even on the capex bit, one thing which I forgot to mention was that the center's loan to states, the interest-free 50-year loan, which is budgeted at 1.5 trillion, only has been slow in terms of disbursements. Only about 250 to I think 300 odd billion was disbursed when we wrote this report. It's probably gone up since then, but that's still a significantly low ratio. And even if the center picks up this number, the criteria, excuse me, the criteria and the norms that states need to meet to get these funds is quite stringent. So again, on that front as well, it's likely that the states will undershoot their capex. The next couple of slides are more of a medium term look at how states capex has evolved. So this one looks at which states have been sort of driving capex over the last 5 years, and the surprising bit is that it's not the large states, it's actually smaller states. So this is sorted by descending order of essentially the state size, so which share in national GDP. So obviously Maharashtra is the largest state in terms of GSDP. But if you look at capex to GDP last 5-year average, it's only 1.5%, which is one of the lowest in our 19 state sample. So the large states, as you can see, their capex to GDP over the last 5 years has been quite low. It's actually been smaller states, the likes of Orissa. Orissa has had the highest capex to GDP of nearly 4.5% average over the last 5 years. Then you have the likes of Jharkhand, Bihar, Madhya Pradesh. All of these states, the small to mid-sized states, as you can see here as well, that have had higher sort of growth rates for capex to GDP. And that is essentially what has driven overall states capex. If I look at the growth and sort of incremental growth, even if obviously the large states will always have a higher share because their nominal numbers will be higher. So it comes out quite beautifully in these two charts because, again, if you look at average capex over the last 5 years, capex to GDP, you can see that it's the sort of the eastern half of the country that has driven this, whereas the western and southern states have actually had much lower capex to GDP. And if I look at the change in capex to GDP over the last 5 years, the southern states have actually had lower ratios in FY24 versus what they had in FY19. So, I mean, obviously the explanation here is quite straightforward, that the higher sort of incremental needs are in these states for industrialization. Western and southern states had industrialized much earlier, so their incremental needs are lower, but it's still quite stark to look at the difference in how relative capex has been happening across the country in the last 5 years. And if I look at a sectoral breakdown of state capex, which is something, I mean, not a lot of people look at, but given the number that states are now printing for capex, and also the fact that states do a lot more diversified capex, as you can see, the center's capex is sort of concentrated to just sort of roads, railways, and defense. But states capex is much more distributed. The two largest sectors remain transport and irrigation, although transport is now the largest sector. Irrigation used to be the largest 5 years ago. Transport is the largest at just about 24% or so, with irrigation at about 16 odd percent. This is as a percentage of states' total capex. But in terms of growth, it's been education and health that have seen much higher growth rates in the last 5 years. But their shares still remain quite low. But the incremental growth rates have been much higher than that of aggregate and obviously other sectors. And over here, again, looking at the incremental capex that states have done in the last 5 years, you would expect to see the likes of UP, Maharashtra, and Gujarat in this chart. So it's a share of the incremental capex. So UP has made up about 17% of states' incremental capex in the last 5 years. Maharashtra 13%, and so on. UP, Maharashtra, Gujarat being the three of the largest states would normally be expected to be here, but the likes of Madhya Pradesh, Orissa, Telangana being in the top six is again an indication of what I spoke of earlier, that mid to small size states have actually been doing a lot more capex than these large states on a relative basis. And if you look at where these states have been doing their capex, it's quite diversified in terms of their focus. So UP has focused quite significantly on health and education, so about 50 billion each on an incremental basis in the last 5 years. Maharashtra transport has remained one of the sort of key focus areas, which is essentially interstate roads and so on. So a large chunk of Maharashtra's capex, incremental capex, has gone towards transport, but it has also improved its allocation to sort of urban development and health. Energy has been dominated by Madhya Pradesh, but this is quite lumpy because it essentially there was a high amount last year, which has skewed this number. But this just gives a flavor of the different priorities on a state-wise basis, but also the fact that some of the smaller and mid-sized states are also showing up in nominal terms in terms of how much capex they've been doing over the last 5 years. And this is the last couple of sections where, first of all, if I look at borrowing on an aggregate total basis, we have estimated about 11 trillion of gross and about just over 8 trillion of net borrowing from states this year. This is taking into consideration, our estimate that states will slip on their fiscal deficit by about 0.2% of GDP. So about 9% growth in borrowing this year from states, from the market. And this is assuming about 77-78% of net borrowing being funded from the market, which had shot up to about 90% last year, which was an anomaly. States in general do about 75 odd percent of their fiscal funding through net SDLs, and that is more or less what we've taken, so about 77-78%. And we've seen a pickup in borrowing in this quarter as well, which is sort of coming back to more or less normal behavior after Q1 had seen a very sharp drop in borrowing, and that sort of only improved marginally in Q2. This was basically because they had borrowed quite heavily in Q3 and Q4 last year. If you remember, Q4 last year was very heavy in terms of state borrowing. I think the last 2 weeks of March alone saw about nearly 1 trillion of gross issuance. And they didn't end up spending that money because obviously the elections came in and there was the model code of conduct was in place and they couldn't really spend. So their cash balances, so we've taken states' holdings of 14-day T-bills as a proxy of their cash balance. So that had shot up to almost 3.5 trillion at the end of FY24. So states were drawing down those cash balances in the first half of the year, and therefore their borrowing was much lower than what they had indicated in their calendars. But this year so far, this quarter so far, they've sort of come to the market a lot more. Even last week's borrowing numbers for this week, which came out last week, are more, in line with the indicative numbers, and we expect that to continue. We actually expect borrowings to pick up significantly in Q3 and especially in Q4 as the sort of fiscal pressure from the populist spending measures that have been announced, especially for those states. We expect borrowing to be quite, heavier in the latter half of the year. It generally is the case. States borrow about 65-67% of their total full year borrowing in the second half of the year, but we expect, much heavier borrowing this year as well. Now, if I look at across state, so this data is still first half, so 30th September, so it doesn't include the last 3 or 4 auctions that have happened in October. But up until the first half of the year, most states had borrowed much lower than indicative, which is why on an aggregate basis, first half, I think borrowing was lower by about 23-25% than indicative. Therefore, most states had borrowed much lower than indicative. But on a YOY basis, you can still see some signs of, the states under fiscal pressure borrowing more. So Maharashtra, for example, even though it had borrowed only 56% of the indicative in the first half, on a YOY basis, it was 64% if I look at the gross borrowing versus the same period last year. West Bengal, 40% increase in borrowing in the first half of the year. Himachal Pradesh, which is well documented fiscal issues, about 100% increase in borrowing. So you could see, even though on an aggregate state borrowing was lower, some signs of the sort of fiscal pressure coming through in the borrowing numbers. And even in terms of their fiscal deficit as well, that is somewhat visible. So if I look at the data that we had for the first 5 months of the year, the percentage of the fiscal deficit that had been achieved in nominal terms, the likes of Bihar, Andhra, Kerala, Punjab, they had all achieved more than 40%. I mean, Bihar and Andhra had achieved over 100% of their fiscal deficit in the first 5 months of the year. And then these were the states that had actually borrowed more in the first half of the year as well, compared to other states. So there is some correlation that is bearing out in that sense on the higher end towards states that are facing fiscal pressure actually coming and borrowing more, and that is something that can be tracked because you get the monthly numbers obviously with a lag of 2 months. But if the monthly figures are showing some fiscal stress, it is quite likely that those states will borrow more in the latter half of the year as well. And the last two slides here are just talking about how spreads, the sort of SDL auction spreads have evolved over the last few years, where they've moved more with regard to supply. So even though fiscal deficit sort of went up last year, the median SDL spread over the 10-year actually declined to about 30 bips last year, even lower than what it was in FY23. And this is the auction spread. So it hasn't moved sort of in line with fiscal health. They've moved more in line with lower supply. So because especially the last 3 years, supply has been much lower than indicative. SDL supply has been lower essentially than what the market has also been expecting. Spreads have moved lower, but what we have seen is that in that narrow range, that there's a very narrow range of auction spread between the worst state, so to speak, and the best state. Some penalization is visible for the sort of deficit and debt of individual states. So you can see that there's only about an 8 bips spread here, but in that 8 bips spread, there is some sort of penalization happening for states that have had higher deficits and higher debt to GDP. So it's not yet a meaningful sort of penalization, but there is some penalization with regard to debt and deficit. Maybe this year with the scale, with if what we're saying, that issuance could be higher this year, especially for fiscally sort of pressured states due to the populist spending. Maybe this year, if in Q4 there's a heavy sort of SDL issuance from some states, there could be some penalization seen in terms of the spreads they have to pay being higher. But obviously we'll have to wait and see if that happens. And the last section here is more about our
you want to take it, Harshal?
Yeah, you can take it. Our assessment of demand supply. Yeah.
So basically the last segment will just take probably 2 minutes on this. So basically, as Harshal said, that we're looking at around 11 trillion gross borrowing by state as against 10 trillion, which was issued last year. On the other hand, when you look at the center's gross borrowing, it's come off from around 15.4 trillion last year to around 14 trillion this year. So almost 1.5 trillion lower central borrowing. And states, on the other hand, again, are showing a divergent behavior where they're actually increased their, or they are likely to rather increase their market borrowing this year. So net, as a sovereign, we are going to be seeing largely the same supply as we saw last year. So that doesn't change much, but historically, what has been generally happening is that, especially last 2 years, that there's been a very comfortable demand dynamics which have played out in bond market, just since very similar to what you saw in equity markets as well, where the domestic investors have been pretty comfortably absorbing the supply. So despite increase in supply that you're seeing this year, led by states, there's not been much of a panic in the market in general. And in fact, there are players who are willing to absorb the SDLs, which are basically issuing papers, under 10 to 15-year tenor. So there's been a decent demand. And on an aggregate basis, also what you're seeing is that, especially the long-only players, which are basically led by insurance, PF, pensions, they have structurally changed the dynamics of the debt market over the last few years. Their AUMs are growing on an average around 10 to 15%. Harshal, can you show that chart where we are looking at the AUM increase? And then we can come back. Yeah. So if you look at the CAGR of NPS that has seen around 30% increase over the last 5 years, EPFO around 15%, and we're looking at EPFO actually, probably outdoing last 2 or 3 years growth. Same is with the case of lifers, where you're seeing around 15% growth in their AUM on an average. Now going forward, also we don't see that thing change very much. Harshit, can you go back to the slide of demand supply? And we are looking at least in the next 2 years or so, this segment being very, very comfortable in terms of the demand side. Which also means that even with a higher supply, you may not see much of a pressure in bonds in general, which is also part of the financialization of the savings that the Indian economy is seeing. The cherry on the cake obviously has been FPIs, which is this year we are expecting around 20 billion plus of inflows from FPI, even accounting for some kind of an outflow which could happen from the active players, especially probably towards the latter half of the fiscal year, which will be largely led by the global volatility. But despite that, I think on an average, we are still looking at an excess supply, excess demand of around 700 billion plus. It could be here and there, we'll have to see. And also just to add, banks are also going to be a decent player in the coming years on a structural basis, because if at all the RBI does, come out with the revised guidelines on LCR, that itself would be structurally positive for bonds at the margin. There was a lot of clamor with regard to the fact that probably banks will have to keep a much higher provisioning for sovereign papers to keep up with the new LCR norms. Our study suggests that most of the banks in India are already sitting with almost 120% plus of the provisioning on LCRs at this point in time. And even with the revised LCR guidelines that will come and play in the month of April or so, most banks may probably assess their their risk management profile and might not want to go back to 120-130% kind of a LCR buffering, but might just be very comfortable with the 110% or 105% kind of a LCR buffering, which basically will imply that banks may not necessarily buy too much of GSECs as some of us were talking about. But there'll be a couple of banks in the public sector, and even the foreign banks, which generally have little close to 100% plus of LCR, will have to probably buffer up. So structurally, it is good for the markets, bond market, that the new LCR guidelines would probably lead to more demands of sovereign papers from bank side. But most likely, it will still not be a very, very big bump, but more a structural delta that we will see. But overall, this year, comfortable demand dynamics, even with a higher supply, no problem as such. That is one of the reasons why lifers who are, or the long-only players who are generally driving the market so far, have kept a very flat or rather, flattening of the yield curve is what we have seen over the last 6 to 9 months. Even with expectation of RBI cutting rates, which was the case until very recently for the September policy, October policy, or December policy, that has also not played out. And I think the fourth quarter also, you are most likely going to be seeing flattening of the GSEC curve, sovereign GSEC curve continue, which will be led by the long-only players. Whether it will be bull or bear, we'll have to see how the global dynamics play out, because we are looking at a relatively more volatile global markets, irrespective of whatever outcome of US election turns out to be. We are looking at a relatively tighter GSEC market in the West, which is led by US, owing to much painful fiscal, which will spill over to the emerging markets as well, and their risk premium will also go up. So we'll have to see how that plays out, but definitely flattening of the curve is something that could continue as a theme for a more medium term in India, because as this table shows, the incremental play is coming from the likes of EPFOs, PFs, and insurance firms, than the likes of banks, who were at one point the biggest player in the demand side of the economy. With regard to the GSEC market, in terms of where we are looking at, the bond yields to sort of settle, very difficult to say, but unless, of course, the RBI actually ends up cutting rate, which is where we think that December could be a very tricky period for them to take a call. It is very difficult to assume that you are going to look at a GSEC 10-year yield coming below 6.5%. Beginning of the year, we had come out with the call that we will not be seeing Fed or RBI cutting rates this year. Fed although has cut rates, but we are still yet to find out whether the rate cut that they have commenced is actually something that they're required to do in a deep fashion that they ended up doing. And also, I think RBI is also watching for the outcome of the US elections geopolitical play and the other factors of liquidity, how they really play out domestically, to take a call whether December could be a rate cut story or it could be pushed to February or even later this year. So as of now, I think pretty safe to assume that we are looking at a flattening of the curve. The bull steepening theme is not fully played out because the expectation of rate cuts for December have also sort of been partly pushed to February. And thus, I think to some extent, you will see that, the curve flattening to continue. 1 and 2, possibly it could also become a bear flattening rather than a bull flattening, if at all the global dynamics, make the US bond market pretty disturbed and volatile. And that should spill over to emerging markets, and India would be no different. I think we'll stop here and we'll take the
There's a
questions.
question from Jaspreet.
Yeah, Jaspreet,
I'll
please carry
unmute.
on. Yeah.
Just a quick question from my end. You mentioned the spread was about 8 basis points. Given the higher supply that we're sort of expecting in the second half of the year, are you estimating a higher spread? Do you have any range for the spread that we could see? Maybe 12, 15? Any estimates that you may have on that?
That's very difficult to say, yeah, because what we're also hearing is that a lot of these long players and even mutual funds are willing to lap up state bonds with a higher spread because there is a decent demand. But definitely so from the current level, you can expect a spread increase of around 5 to 7 bits maximum. Not much.
Got it. Okay.
Because there's a decent demand which is there in the market, even at higher rates. So they will come off.
Okay, got it. Thanks.
Next is Ashoka Mitran.
Yeah. Hi. Hello.
Hi.
Am I audible?
Yes, please.
Yeah, it's Ashok from the Hindu. So the question I want to ask is the benefit transfer schemes put in the context of slow demand, as Finance Ministry had spoken about in its monthly review. Could it create a multiplier effect that in effect could actually increase some amount of economic well-being at the rural level, especially for Maharashtra? Do we have?
So there's yes.
Look
Obviously,
at it as an expenditure.
Yes. Obviously, when policymakers are expanding their balance sheet, there is going to be a multiplier effect. There is no doubt about it. This time around, obviously, they're trying to sort of cater to the lower strata of the economy. So there will be a consumption benefit to some extent, but let's be very sure of the fact that this particular segment of the economy was absent all this while post the COVID recovery in consumption that we saw. To some extent, that was also led by the fact that the balance sheets of rural households were quite, broken or quite, uncomfortable. So there's a good chance that, this excess savings that they're going to make out of these transfer, part of it could also go in repairing the balance sheets of household or paying off their debt. So not necessarily all of it will be immediately spent in consumption. That's one part. And even if it is being consumed, it will be obviously the marginal propensity to consume is much higher for the rural sector.
Right.
But that said, again, it is going to be one state of the economy which those spends a lot out of their, income or the money in hand. But the delta effect on overall consumption dynamics of the economy is much lesser because on a contribution point of view, they're still lower a player than, say, the upper or the urban upper middle or beyond that, a consumption class. So the marginal impact would be still much lesser than what you would see if there's a more widespread or an urban-led consumption demand increase. So I think, it is unlikely to lead to a very high multiplier effect. To some extent, it will be saved. To some extent, it will be spent. But they are, again, a marginal player in this big consumption story that India has.
Yeah. In your assessment, then what is the alternative way of fixing this problem? Now, CapEx has a long gestation period and it cannot create that immediate consumption upward trend. So what could be an alternative way of doing this?
See, again, the alternative way to do is two things. Firstly, we have to think as to how the policymakers want this growth story to play out. To be very fair, if you look at the way the fiscal policy has played out in India, they also followed a very manufacturing-led or supply-side-led economics and not the demand-side-led economics. They do not necessarily want a consumption-driven economy. At least the Modi government has been very clear they would not want to repeat 2012-13. So, the stimuluses have been again very focused toward industrialization of the economy in general. The benefits that have been also accrued to the economy have been flown via the industrial sector, not via the consumption segment. And I don't think that is going to change much. They are trying to sort of ensure that, it doesn't worsen from here on, but I don't think there's been, in that, which you can also see in the budget as well, post whatever happened in the election. There's not been much of a change in the budgetary dynamics of the Modi government. They have tried to actually still contain fiscal deficit to below 5% instead of keeping it at 5.1%, which was the prelim budget estimate. So they are very clear that the growth story in India shouldn't be led by consumption. So while we are seeing, the Modi or the BJP-led state governments also following suit of, what we saw in the, the non-Modi era, where there was a lot of spending, which was basically more toward non-merit goods. It is also repeating somewhere in the Modi government led or the BJP-led states. But overall, I still believe that on a consolidated, centralized point of view, the view is that they don't want a consumption-led growth in economy. All they are trying to do is just ensure that somewhere this consumption pain is not going to be widespread and it doesn't worsen from here on. But I doubt they're looking at really making the economy move via the consumption route. I think this strategy is not going to change, but the way to really still break the consumption pain is to probably look at the way how the labor market dynamics play out. A large part of the consumption, improvement that happened post-COVID was also held by the urban income improvement, which was again led by the services sector's, job mania, which was again driven by IT and BFSI, which is where we are seeing a slower growth story to, now play out in the last 1 year, and probably it will continue in the next 1 or 2 years as well. We are seeing a slower global growth picture, which will spill on the services sector, which are basically tradable services. So there is going to be a slower urban income and urban consumption consequently, which I think to some extent the government may not be able to have a very great handle on, because this pickup in our urban consumption was also not led by the government, but was a very natural progression of the global cycle where we also enjoyed some gains. The only way they can really prop up the urban consumption is by probably giving tax cuts. And I'm not very sure that this government is willing to let go of its revenue stream, because they, again, are trying to ensure that, a healthy revenue stream is somewhere positioned back into the spending pattern, again, which is led by more capital expenditure than revenue expenditure. And that broad thesis has not changed. So I doubt that they are going to be giving big relaxations to the, urban middle or the urban class in general in terms of much lower tax regime. I think that's something which will play out much later. So that side of supply side economics is not going to play out. So I think near term, one has to accept the fact that we are not looking at a massive improvement in the urban consumption. Rural at best would be sort of capped at the current level. We may not see a big excitement in terms of the secular recovery, maybe cyclical, yes. But urban is going to probably see a double K-shaped story, wherein the premium segment is still doing well, while the upper middle income strata, which had started enjoying the wealth effect and the income effect, will probably sort of slow.
Great, thanks.
Rosebud Gonzalez.
Yes, hi, thanks. My question is on the LCR guidelines that Madhi ma'am, you just briefly spoke about. So, like you said, most banks are having their coverage above 120%. There are a few banks who are also having this coverage of about 130%. And in one of the earnings calls by a bank, they said that, this is just a timing difference, and once the new guidelines come in, which is expected to be around,
This quarter,
which is expected to increase the LCR by about 6%, the overall average LCR will kind of normalize and come below. So I just wanted to get your opinion on that.
Yeah, I agree with him, because that's what even our assumption is, that at this point in time, most of the banks are sitting with, a massive buffer on their LCR. So the new LCR guideline in effect would reduce banks' LCR by, 7 to 10%, assuming 50% of the deposits which are linked to the internet and mobile banking are going to be, sort of taken on their books. So that's what I'm pretty much in the same page as, what you're saying. Just that with regard to, since we were focusing more in terms of, how, HQLA probably would be increased from GSEC demand point of view. That is where we were differing, that most banks, because they're sitting with a high buffer in general on LCR buffering, they may not necessarily, lead to a much higher demand with regard to the GSEC market.
Right.
But otherwise, I agree with you. This, in fact, would actually reduce the bank's, LCR by 7 to 10% roughly.
Okay, right. Do you see like some kind I mean, structurally, this will increase the demand for GSECs, but in the near term, when these guidelines come out and when that actually plays out, will you, what is it that you see for the bond market at that point?
Yeah, bond market is one already aware of this, coming into play, and most of the banks already prepared and discussing in their boardrooms as to how they want to go ahead with regard to how much HQLA they want to further put in their books, or they are okay with a much lower HQLA than what they earlier used to keep. So then they'll have to probably take a call with regard to, their own risk management. They might reassess their risk management profile altogether to sort of understand how much they want to align with the new estimated requirement. But structurally, it is definitely good for GSEC demand because you are, as a bank now required to have much higher HQLA, which is generally led by sovereign papers. So clearly, structurally good for them, but not necessarily change the dynamics immediately, because as I said, most of the banks are sitting with very high HQLA, more than what they are needed to have at this point in time. So when the LCR guidelines come into play, they probably would be sitting with maybe 105, 110 of their HQLA requirement versus the 130 plus that they have right now. So they're still over and above what would be required after the new guidelines come into play. So they may choose to not go back to their, pre-new LCR guidelines era. So structurally good, but not necessarily to a spurt of demand in bonds as such.
Yeah. Okay, thanks.
Surabhi.
Hi, can you hear me?
Hi, Surabhi.
Hi. So I have a couple of questions on state finances. You spoke about how the combined fiscal deficit of states could go over 3.2% this year. And my concern was about, worsening finances of states like Himachal Pradesh, and what this whole current set of freebies by states coming up for elections means, and whether we could see even more worsening of the finances going ahead, maybe in FY26 or something. Thank you.
Harshal, do you want to answer that? I'll probably just speak a line or two and then you can pick up from there. So specifically for the state that you asked, maybe he has a better handle on that. But broadly, as he was also mentioning that what's happening in the state fund is that while they've increased their expenditure profile, which is probably led by a higher share of committed expenditure, they are still struggling to raise or mobilize their own tax revenues or tax revenues which are not their own. And that is where the problem area lies for states, because they don't have a very strong income profile to cater to the increased spending that they have on their books at this point in time. And the casualty is going to be either a sharp cut in capex, or again, overestimation of revenue in the early part, and then they're slipping on their fiscal by the end of the year. But definitely it's something which is going to have a medium-term effect, because most of these schemes are sticky in nature. They only probably tend to, and since India has a election cycle which is always ongoing for states at least, and we don't have a single election profile wherein you probably can see a more synchronized spending pattern for states. So every now and then, every year, there will be some state or the other which will be going into elections, and if there's one state formula which has worked, it is likely to have a demonstration effect across states, and which is what we saw with the Ladli Behna, which started off from MP, worked well in Haryana, and now is apparently working well in Maharashtra as well, as far as the political party's popularity is concerned. So it is likely going to be the case that once these freebies and populist schemes come into play, nobody wants to get everybody loves free money, right? So it's very difficult for them to reverse on these populist schemes, and they become a sticky expenditure. And not to forget that states actually will probably have a much worse debt profile than center, which means that their interest payments are probably going to be rising much more than centers, where center is consolidating sharply over the last few years. States probably going ahead have a much more stickier fiscal deficit, probably stay at around 3% or 3.2% going ahead. You will see states' debt to GDP ratios actually worsening than that of center, which means that the interest payment burden for states would be much higher than for the center in general. Harshil, would you want to add anything here for a specific state that she asked for?
Yeah, so obviously, Madhavi's spoken about the sort of general situation. And with regard to Himachal, it's obviously in an extreme position. If I remember correctly, I think a couple of months ago, the chief minister had asked ministers and cabinet and sort of secretaries, etc., to not draw salaries for 2 months because that was how bad the fiscal situation of the state is. So it's in an extreme position, but it's the triggers are more or less the same as what we've spoken about. They've also promised 1,500 rupees a month to women. That's, I think, projected to cost about 800 crore per annum. So, 8 billion per annum, which is, I think, about 0.4% of the state's GDP. They had gone back to the old pension scheme, which is going to cost some 10 billion per annum. That is, again, 0.4, 0.5% of GDP. So, similar to what we've been saying about all the other states we covered, obviously, Himachal didn't come up there specifically, but it's a similar, evolution of how the fiscal profligacy has especially taken hold this year and probably last year. Over 1% of GDP probably being spent on populist measures, and that pressure only growing. So it's an extreme example, but the triggers are the same as to what we spoke about, where the sort of populist push that has happened has put them in this position where, they're not able to pay salaries for the last 2 months, or they've at least asked people to give up their the state employees or whatever to give up their salaries. So Himachal is I don't see how it can improve unless obviously these schemes are cut back on. But as Madhavi said, it's quite sticky. Once you announce, it's very difficult to roll back. So you can only possibly see this situation worsening. That's why we mentioned it here as well. There's more of a medium-term concern. Even this year, on an aggregate, states may sort of slip by about 0.1, 0.2% of GDP in terms of the budgeted number, but that slippage could possibly increase in the next few years. Maharashtra, for example, there is an argument that it has the fiscal space to do this populist spending, because even after the increase, it's only budgeting about 2.6%. Its debt to GDP is the lowest in the country across states, I think, at about 20-25 odd percent. So it has the fiscal space to do this, but that's the point, that incrementally this can become worse and worse, and therefore that burden increases. So you may see some pressure for a lot of states coming through, if not this year, then maybe in the next 2-3 years, as you're saying. But Himachal specifically, it's the same issue that has happened across all states, just that it's in a more extreme position than some of those states, which is what the concern is. Even though it's in a fiscally bad position, it's still sort of going ahead with these schemes.
Next question is from Siddharth.
Yeah, I had one more question.
Yeah,
I'll ask that later.
Please go ahead. Siddharth, just wait.
Okay. Yeah, sorry about this. I just had one more question on, GST revenues, and a lot of states have said that, they're yet to reach the pre-GST, kind of revenue that they were getting. So just your thoughts on that. Thank you.
So overall, the GST regime has not necessarily led to any increase in revenue neutral state, which was the case pre-GST. In fact, for center also, GST as a percent of GDP has largely remained sub 2% or 2%, which was the case even earlier also. So at least for central, it was still able to achieve. But for states, some states are still struggling with regard to reaching their pre-GST era in terms of revenue neutrality. And that is why there's a lot of clamor that they are going to look into revising the GST slabs, something which is, in the making. And as of now, I don't have a view on that, but I think the the GST Council is looking into, improving the tax slab structures to ensure that states, at least get, because they're no longer getting those, compensation cess, which they were getting earlier from the center. So clearly some states are at a disadvantaged position compared to other states who have been able to be more revenue neutral. And I think there's a work which is going on in regard to rebasing of the GST slab, but that's about it as of now. Otherwise, I mean, as of now, the states are going to be sort of struggling with regard to going back to their pre-GST level, unless, of course, the overall income profile of the economy improves.
Hi, Siddharth from Informist here. Just a question regarding the debt. I mean, the center is moving to a debt to GDP ratio target from FY27 onwards. If a similar metric is applied to states, even if the fiscal deficit is expected to rise this year by 20 basis points or so, and maybe even next year, I think it would be safe to say that the state's debt to GDP would still fall. I mean, some of them show nominal growth of 14% this year or last year. So is it possible that a move to a debt to GDP framework will possibly understate the weakness of state finances?
To some extent, see, the states number anyway don't go beyond 3% on an aggregate for a long period, because states have this constraint of not being able to borrow more than 3% from the market. It's currently at 3.5%, where 3 is what they get plus 0.5, which is conditioned on power reform, the labor reform, and the likes of that. So clearly for states, I think a more medium-term numbers still would be around 3% if I take a, say, 5 years average from now. Maybe a few years they'll slip and then they'll have to get back on path, because that will start straining their fiscal or the debt profile for states, which I think would be, and see, while the states can estimate a much higher SGDP overall, but I think it's fair to assume that, and since states data is always with a lag and we don't actually get to know the states' GDPs on a more real-time basis, it's fair to estimate that the national growth is very similar. I mean, states' growth on an aggregate would be very similar to what national GDP numbers show, which clearly at this point in time is not going above 11%. In fact, we had done this study or this mathematics with regard to, how the debt profile of the economy would play out. And since, as you rightly said, center is now focusing on, monitoring the debt to GDP ratio once they reach a 4.5% fiscal deficit. This is largely on account of the fact that, they would actually find it very difficult to grow the economy without really, by constraining their fiscal further, because there will have to be some sort of a trade-off that they'll have to play. Either they are, willing to spend much more going ahead, and which will lead to a much better, growth profile, or constrain their fiscal further from 4.5% to maybe a 3% or whatever, to ensure that the debt to GDP comes down. So even if I assume the center is, say, sticking to a 4.5% fiscal deficit for the next 5 years, and states on an average are still 3% for the next 5 years, at a 10% nominal GDP growth, and if I assume that all the incremental fiscal deficit is basically going to be the debt on the books of center and states, the the debt to GDP ratio for the next 5 years would probably remain where it is at this point in time, which is around 83-84%. So maybe a tad lower, but not much of a material difference from where it is right now. On the other hand, if the national nominal GDP grows by, say, 9% for the next 5 years or so, with the same center and state fiscal profile, which is 4.5% center, 3% for states for the next 5 years, your debt to GDP ratio actually increases because your denominator is going lower. So the debt to GDP ratio goes to around 87% or so. On the other hand, if I assume that, the policymakers are able to buoy the economy, or the economy grows to, say, 11% owing or above, owing to natural factors or by policy-led factors, the debt to GDP ratio, that is the only case where it actually comes off to sub 80% to 70-79% for the next 5 years. Else, with the current profile and with assuming that the states overall behave to 3% and center also constrained itself to a 4.5%, with a 10% growth in the economy, in the nominal GDP, you are likely to see the debt to GDP ratio remaining as is. And that is where the policy constraint is, because we are assuming that none of these will be sort of spending way too much from their current profile, which may not be the case. So there's a good chance that the debt to GDP ratio actually starts to increase before coming down. And that is where the policymakers are now getting worried, and they have started to sort of target, because historically what you've seen is that any economy which crosses 90% of debt to GDP ratio it starts to impede the GDP growth directly on an incremental basis. So that obviously is something that they do not want to have on their books. And as I was mentioning, that interest payment as a percent of GDP for center itself is about 3.5%. For states also is close to 3% plus. So overall, I think it will be a very difficult task for them to assume, for them to sort of take a call whether they want a much higher growth at the cost of a much higher fiscal, or a relatively lower fiscal with a lower growth, or maybe a fiscal which is very well optimized in a way that your medium-term growth becomes a more 11% than say a 9%. Something which I at this point can't take a call on, but definitely the debates being discussed in the policy arena as to what they really want over the medium term. But it's going to be a very difficult task for them to really bring down debt to GDP ratio below 80%, unless of course they contain their fiscal and yet ensure that with the contained fiscal, the optimization of the fiscal spending is much better.
So Jaspreet, I think she has question again. So just a moment.
Yeah, Jaspreet, tell me, it's a he.
Oh, sorry.
Oh, hey, hi. No, all good. Just a follow-up question asking on behalf of my colleague. You mentioned the consumption slowdown. Just wanted to get your quick thoughts on, given that the government cannot do a lot about it or has not done a lot about it so far, how are you sort of adjusting that with your overall economic growth outlook? How are you factoring that in the medium to near term?
Yeah. So we were actually below street on the growth story beginning of the year itself. We were looking at a 6.5% GDP growth for FY25, wherein the biggest factor, of course, was the fact that the GDP versus GVA wedge, which was where the GDP sort of soared to 8.3, 8.4% last year, will normalize. So the GVA, which is a more stable way of looking at growth, probably slow from a 6.6, 6.7 to 6.3, 6.4%, while the GDP will come off from an 8.3, 8.4 to a 6.5%. But the growth players, in my opinions, have not really changed, wherein we are looking at a missing behavior of private sector agents. So then they have remained sort of missing in the last 1 year. They've become much more prominent now via the private consumption route also, wherein we were seeing some bit of an urban-led consumption story, which is now going to be missing. And obviously, if we are looking at consumption being not much of an excitement in terms of its contribution to growth, it's unlikely that the private investment are also going to really play its part, because they generally are endogenous in nature. So while there will be some compulsive investment which have already happened, owing to factors like some companies sitting with excess cash in hand, or some companies which are moving to improve the supply chains given whatever is happening geopolitically, and they don't want to depend on the global supply chains, or some are doing investments with regard to the energy sector or evolution of the energy sector towards a more greener world. All of that apart, there's not a very animal spirited investment that is being seen, and that I think would be driven only by the private consumption, which is where the problem lies, because until now, and in fact pre-COVID itself, the rural story was a missing play, which didn't improve post-COVID. In fact, the rural segments, non-agriculture sector has actually collapsed dramatically post-COVID, which had recovered to some extent, but we've not seen the income profile in the rural economy improve dramatically. The only thing that we are seeing in the near term is that this sort of has been, to some extent trucked in terms of how bad it could go. But whether we are looking at a secular rural improvement is something which needs to be seen, because agriculture is only 25% of the rural GVA. So it's not something which will totally move the rural consumption story as such, even with the better pricing of food components. But urban, on the other hand, which was enjoying the premiumization of the economy in the early part, and we saw the whole K-shape, becoming much more prominent. The second leg of post-COVID improvement was led by the urban middle class, wherein owing to improvement in the urban job market and owing to improvement in the urban incomes profile, we saw even the upper middle class also joining the premium segment of the economy in terms of the consumption profile, which is now going to slow, because while the premium economy may still continue to do some be more resilient. You will see the likes of the upper middle class, aspiring middle class, which is now bearing the brunt of a much slower labor market, a large part of it led by private sector. So the government can only do as much in that segment. And overall slower income growth also on the real basis, which will start hitting the urban consumption behavior. So I think the slower urban consumption story is what we were discussing even a year ago. And that has actually played out, wherein within the urban sector, you are seeing a urban K-shaped story, wherein the premium segment is doing okay, but the middle segment is now going to be the missing part. So, we are going to be seeing a missing private sector led growth story in the next 1.5 years, unless of course we see a much more concrete of efforts from both ends. It's unlikely you're going to be seeing a structurally driven growth story, because public sector can only do as much in terms of driving. It can help revive the sentiments, but again, a large part has to be also driven by how the global cycle plays out and how the private sector back home also, sees the growth story overall, because they are very endogenous in nature. They sometimes go hand in hand to the extent that it's very difficult to say which one will go first. But as of now, I believe that if there is no private consumption, it is unlikely there will be private investment with an animal spirit.
Got it. Yeah, I mean, one of the MPC members had also flagged that Indian corporates are facing, one of the new MPC members had flagged that one of the Indian corporates are facing a demand deficit, both internally, externally. Externally harder, but internally, are there any steps you think the government can take to help them a little, or it's going to be animal spirits driven, as you said?
To some extent, see, they have, as I was mentioning earlier as well, right? What is the way for any policymaker to increase consumption? They have to expand their balance sheets, right? And the center has been only consolidating its own balance sheet. I think monetary policy has been much more neutral to growth, and fiscal policy on net has been actually constrictive or constraining growth to some extent, because every consecutive year you've only seen fiscal profile becoming much better for the government of India. They have tightened their balance sheet because they wanted to reduce their debt to GDP ratios from the 89% high to where it is now, which is 83%. So they had their own constraint to take care of, to improve their own balance sheet, so that once their own balance sheet is clean, and if there is a need for the growth upliftment from the policy, and they at least will have the space to do so. So I think they are aware of these challenges. I think the policymakers also reckon the fact that to some extent, them not spending enough has costed them in this year's election also. But as I said, there's not been much of a change in their, at least the center's policy prerogative. It's more from the state side that you're seeing, a spending profile which is more revenue expenditure led. So it will have a multiplier effect, yes, but it's going to be very short-lived, because the RevEx led spending also, which while it leads to an immediate impact in terms of fiscal multiplier, it is also a much short-lived impact. So we'll see how it plays out. But again, a lot of households, especially in the rural segments, are sitting with pretty jarred and pretty broken balance sheets, and they will also try to sort of improve their balance sheets before actually looking to spend the money that they're getting from the center. And again, it's a very low income strata of the economy, which while spends large part of its income or the money that they have in hand, but has a marginal role in terms of improving the consumption profile. So maybe center can choose to, if they're okay with, taking a call that near term they can have a hit on their finances, and they can bear that hit on the finances, they can probably choose to cut income taxes if they want to improve the middle income consumption profile. But I think near term, they are just going to probably focus on rural and little bit here and there on the urban segment, but nothing very dramatic that they want to do. So a large part will be again driven by the private sector. Just as I said, the urban consumption story was not led by the government, it was the private sector. To some extent, we enjoyed the opening up of the global economy where manufacturing did pretty decently well. We saw exports-led economy, help the growth story in India, which was followed up by public capex. So we saw some improvement in certain sectors like construction, real estate, and also, of course, the services sector, which was exportable, which is basically led by IT and GCCs, wherein you saw the urban play really come out well. And even for the segments like BFSI, which are basically, driven by the improvement in the overall financial sector, performance, which also helped that segment of the economy. All of that is now fading. So these are all, very free market levers. So it's very difficult policymakers to really instill any kind of growth story in those. All they can do is spend or do supply side reform where they're willing to take hit on their revenue side in the near term to ensure that the consumption improves and eventually the revenue that they lose in the first 1 or 2 years get covered up by higher consumption and higher income eventually. But that's something which is very difficult for them to take a call on, because I think the policymakers on the central front are very fixated on improving their fiscal profile at this point. So I think they're using the state's lever to increase spending. But net, we are still seeing a fiscal profile of India actually tightening. So I think you'll have to look at non-public players to drive the economy, which is where the problem lies, because they also are now going through difficult times.
Thanks a lot.
Thanks, everybody. And okay, we've got one more last question. Siddharth again.
Yeah, hi, just a quick question. Do you have any estimate for how much the 16th Finance Commission can increase the tax devolution to without affecting the center's finances too much?
No, I wouldn't have an idea as of now on that. I think insofar if Herschel can show that slide, any which ways, center has been giving less than 40% of the divisible pool to states. And also they have been sort of ensuring that the divisible pool itself becomes a much smaller play in their own kitty, because they are essentially trying to increase their tax profile by increasing all these surcharges and cesses and stuff like that. So I think there could be a tap on that. If at all the pay commission sort of starts to look into it in a more different fashion. But obviously it'll hit the center's revenue kitty also. I don't have much of an idea on as to what they are thinking, but this is something that even we highlighted, that generally they have sort of been much lower than the FC recommendations of the last Finance Commission that played out. But still, interestingly, states are still enjoying a much higher tax devolution that they themselves budgeted, because overall the center's revenue kitty has been so strong that this particular item for even states is doing very well on a Y&Y basis. But clearly something that is going to be discussed at the next FC, because a lot of states have not taken this very kindly, that center is finding ways and means to reduce the divisible pool by finding avenues to raise taxes via these tax levies and all these other non-divisible pool-led stuff. So clearly something to be discussed, but I'm not sure how much they would actually be changing. But there is going to be some kind of a reform in that front, where center would be penalized to reduce the cess and surcharges and actually increase the divisible pool. And especially when they are using states as a lever to spend now, not themselves. Okay, guys, thank you so much for your time. We are logging off now. Do you have any other question? Anyone has a question, or we should just end the session? Well, thank you so much. We'll see you around.
Yes.